Welcome to the weekly update, where we'll go over the action in the market for June 6th through June 10th, and then we'll look ahead to see how things look for June 13th through the 17th. And it ended up being a pretty negative week overall. I've got a lot of charts to show you. I'll try to go through this quickly to avoid making this video too long. Let's go back and talk about the week's session. Just to go back over what happened, there were a lot of companies, big companies, that came out and negatively revised their forecasts, and that kind of bled through the market. One was Target, a big retailer. Intel, of course, was semiconductors, and Scott's Miracle-Gro. Apparently, they're a big player in the plant business, but they all revised things down. And there were other companies too, but these were just kind of the biggies. Oil went as high as 123 at one point. It settled below that. And natural gas, which I'll have a chart to show you both of these later, it went as high as 966. The OECD, and they measure things on a global basis, and they had predicted that GDP was going to be at 4.5%. Well, they cut that down to 3%. Also, the Atlanta Fed GDPNow model, which I'll show you a chart of that, their estimate had been at 1.3%. They lowered that down to 0.9%. In Australia, they raised interest rates as well as in India, and in both places, it was more than what was expected. That caused some negativity to flow through the global markets, which inevitably fed over into the U.S. market. The European Central Bank, they met this week. It was speculated that they might raise interest rates. They didn't, but they said, we're probably going to do this at our next meeting in July. And we'll probably even have more rate hikes after that. They also said that they're going to end their version of QE starting in July, and they raised their inflation rate to 6.8%, where it had been at 5.1%. They projected inflation for 2023 to be 3.5%, where it had been 2.1%. So not only within the U.S. are we seeing a lot of negativity and really rising interest rates, this is happening globally. Also, just when we thought the lockdowns were over in China that might help some of the supply chain issues, they're in lockdown in certain parts of Shanghai right now. That could bleed over into some of the anticipated improvements with the supply chain. Consumer sentiment came out on Friday, and it's the lowest reading that they've ever recorded. And from what I understand, it started back in 1978. This reading was at 50.2, and I have a chart where I'll show you that. Then the biggie. This is what really set the tone for Friday and for the week. The CPI was released, and it came out at 8.6% on a year-over-year basis. This is the largest increase since December 1981. I don't really rely on these biggest, largest, up, down, what have you, because we don't necessarily know the context. Now, I do remember the context of 1981, and it was still pretty negative, but things were different in a lot of ways. So to try to make a complete comparison is not necessarily fair. The political climate was different. We were at sky-high interest rates at that time, coming down off of massive stagflation, which a lot of people think we're getting into now. There had just been a recent change in the executive branch. We had a new president. That's when Ronald Reagan came in. So you can't make an apples-to-apples comparison when you're looking back. I know the financial media likes to do that. Now, if you take out, for some reason, food and energy, they call that the core CPI. And of course, we all need food and we all need energy. They try to give that a more realistic measurement. That was up 6% on a year-over-year basis. And it was down from 6.2, what we saw last month. It's still way above the Fed's goal of being at 2%. So overall, this was really negative. There had been a scenario in the markets that after the CPI came out last month, since it came down a little bit, they were thinking maybe inflation has topped out and we're going to start coming down and maybe the Fed won't have to raise interest rates. Well, that got totally blown out of the water, not only by the CPI report, but we're getting a lot more statements from the Fed that are not turning more dovish. If anything, they're getting back to a more hawkish stance, which means they're going to really tackle this inflation thing by raising interest rates. That's their main concern right now. And of course, some people say we're well behind the curve. We're just raising interest rates now, where we have treasury yields in the 2-year up at over 3%. We've got a long way to go to get to even matching any kind of interest rate level that might be needed to slow down inflation. We ended up being down 5.05% for the week. Volume was below average. Now, we spiked up on Friday. That was a big panic day and everybody was freaking out. But we've seen pretty much across the board below average volume all the other days. The technicals are negative, and I'll go through all the charts and show that to you. Inflation and interest rates are what U.S. investors or people that invest in the U.S. stock market, that's what they're really concerned about, as well as on a global basis too. A lot of geopolitical concerns, the supply chain issues, as well as the possible lockdowns again in China. Oil is just going to the moon. The Fed speak isn't really market friendly right now, which then bleeds over into their policy. And then the earnings as they come out. Sometimes they can drive things more positive. Other times that can be more negative. The condition of our trend is we are negative and it's getting stronger on the weekly chart. We're in a non-trending environment right now on the daily chart, but that's probably going to change pretty soon. There's a big negative bias on the daily chart as well. So let's go back and look at what happened. Right here in about the middle of the chart, this was Monday. And we actually gapped up and things were like, okay, great, wonderful. Well, that ended up being the high for the week. Then we came back down to the pivot level and gave up a lot of the gains that we saw earlier in the day. On Tuesday, we gapped lower, but then saw a really nice rebound. This was a pretty healthy move. And it's like, okay, maybe some good things are going to happen. Then on Wednesday, we kind of went sideways for a while. And then as the day went on, things dropped much more negative. Thursday, we had a pretty significant down day, and then Friday, we just kept going and going, and we closed at the low for the session. If you look back here, these were the lows that we set back in May. Are we going to retest these lows again? It's a little more prevalent on a daily chart, and I'll show that to you. So for the week, the Dow was down 4.6%, the NASDAQ 5.6%, the S&P was down 5.1%, and my charts are a little bit different than this. And the Russell 2000, which are the small caps, they were down 4.3%. Here's what it looks like graphically. Everything was down across the board. Looking at our sectors, all of them were down. The financial sector got hit the hardest, followed by tech, real estate, materials, discretionary. They were down over 5%. The one that did the least bad was energy, and it was down 0.89% on the week. And here's how it looks graphically, just to show you how we performed as the week went on. Looking at current market valuation, they're still saying that we're at fair value. Now, these charts are going to look a little different if you watch these videos. We usually have a live chart behind this graphic here. Well, for some reason, it's not showing up. Maybe that person's on vacation this week or something. As far as the yield curve is concerned, we're at a fair value. The Buffett indicator is still overvalued. That hasn't changed. The PE ratio is still overvalued, and I'm going to talk a little bit more about that later. Interest rates are fairly valued, as is margin debt, and we're still overvalued on a relative basis to where our current price is in the S&P against the mean price over a period of time, even with the declines that we saw. Looking at sentiment, we're down at 28. We had been in extreme fear territory for a long time. We bounced back up. Well, we could easily go back down into that area. Another thing to consider is this is not necessarily a climactic reading right now. And this just shows you historically where we were below 25 for a long time. We're able to get back above that. Now, if we see further declines, we're likely to go back down below 25 again. Sentiment. People are just not happy on any front right now. Economically, politically, in pretty much any area that you look at, where we're seeing the 2-year yield really going up. It's up over 3%. My gosh, look at this parabolic spike up. Well, this blue line is how people are feeling. And this came in much, much weaker than expected. And so if you look down below, there is a huge gap between the yield and how people are feeling. And so one of these is going to have to give at some point. It'll work its way out over a period of time. We don't know exactly what will happen. Will interest rates come down, or will people suddenly get happy again? We don't know. Or it could be a combination of the two. This just shows that when we get that consumer sentiment reading that I just showed you, it really lines up with recessions. And that's the big debate coming along right now too. Are we going to go into a recession or are we not? And going back to 1980, when we hit lows with sentiment, that usually corresponded with a recession. You can see these gray areas in here. These are recessions. Well, we're getting pretty low again. Are we going to head into a recession? This chart suggests that it's highly probable. This next chart just measures the difference between high yield or very risky loans and treasuries, which are considered to be very safe. When this line is really going up, that's when we get concerned, but it's not necessarily spiking right now. If you look back to 2008, this was the financial meltdown. When we had the COVID plunge, this really spiked up. Yeah, this is going up, but it's not necessarily spiking right now. This next chart is the same chart that we just looked at, but it has some more annotation on it. And if you want to pause this and look this over, the black line is the S&P 500. The blue line is the spread that we just looked at, and then there are some different events that happened on here. I won't read these to you, but feel free to just take a look at this. We also had the updated version of the Ridex Bear Bull ratio, and people are getting a little bit more scared, even though we spiked up a lot higher than where we're at now. So we saw it come down, but it's still pretty high. So they're getting into more bearish funds that benefit when we go down than they are the bullish funds, which benefit when we go up. We're also seeing individual investors starting to be extreme negative again. We had come down to this level before, recuperated a bit, and now we're back down into this extreme negative reading. I went to their website. I'm a long-term member of AAII, and I just took some screenshots. What they do for this survey is they just count the bullish folks and then the bearish folks that are in red. They kind of throw out the neutral people. And then here, they just put this on like a speedometer type of thing. Now, I would reverse this. I would have the red fearful over here and the greedy green over here. But, okay, they didn't read my email. But this is just starting to come down, showing we're at minus 26, and we're starting to get a little bit lower. And we could go lower than this. And we use this as a contrary indicator. The VIX, at first, when I was doing the daily video, I said, man, the VIX really spiked up. No, it didn't. To see how far we've come down, especially with Friday's move, and to see the VIX not go up very much on the daily chart, let alone here on the weekly chart, this is kind of interesting. We're not seeing a real spike in fear, although it did go up for the past week. And if you see down here, here's the bar chart. We would want to see this go a lot higher if we're getting to an extreme reading. This just suggests that there's not an awful lot of fear right now, and we could head lower. And if we do, then this is likely to continue going higher. Another chart that I got from the Fed site, this takes the last 3 months of the VIX and kind of crams it down into a smaller chart. And it shows that we're not necessarily spiking, even though we're having a lot of trouble right now. Other times when this really spikes, this was the COVID plunge, this was the financial meltdown. We're not seeing it really going up higher right now. Another indicator that measures fear is called the ulcer index. If you think about it, this measures when things are going down and everybody's freaked out. On the daily chart, we're pretty much neutral. But here on the weekly chart, we're seeing a real increase in fear. We also had the updated version of the National Financial Conditions Index. When we're below this black line, that means that everything's okay. When we get above this black line, that's when people are really concerned. And the things that are used to make up this index really spike up. Well, yeah, we are increasing and going up over here, but we're still below the black line. Another survey that was updated this week are the active asset managers. And it shows that they've gone back above 50. Now, that could be considered to be more neutral. We are seeing this recover slightly, but at other times, this actually marked a low in that survey. This tends to get a little bit more positive when we go above 60. So we still have a ways to go. Now, with the declining week, it's probably safe to say that this index is going to fall. And then down below is the S&P 500, just to give a little bit of perspective. We're still seeing insider transactions giving us a bullish reading. It's at 10. When it's below this black line, that tends to be bullish for the market. It did climb up since the last reading. I think we were at 8 last time. When we get up into this area, that's when we're bearish. So this could give some support to prices going higher. But we've been seeing this now for most of 2022, and it hasn't really provided much of a catalyst to go higher on a strong trending basis, at least yet. Looking at some earnings and valuation. This is a thing called CAPE. Now, if you've ever heard of Robert Shiller, and I would highly recommend his book, it's called Irrational Exuberance. He's kind of the rock star economist these days. He came out with the book. He has some updated versions of that book. He also has a website that he maintains where a lot of the things he talks about in the book, he updates on this site. I will include a link to his site in the description below the video, and it's freely available. You don't have to pay anything to get there. You don't even have to register. This is the cyclically adjusted PE ratio, or CAPE. So every time we peak and then it goes back down, it falls below the mean. The mean is about 16, 17 or so. That just means when prices get above this yellow line, they're too high, they're expensive. So when they spike up and then come back down, and I've tried to circle the areas, and I just eyeballed this myself. It's not necessarily scientific, but it just shows what happened after that. We spike up, we come down, and then we end up going a lot lower. We end up dropping below the mean price. And that's happened pretty much historically going back into the 1870s. The one time that it did not happen, I have circled in blue, that was during the COVID plunge, and that happened so fast when the Fed came out and said, unlimited QE, and the government came out and said, we're sending checks to people. Well, that really bounced everything right back up, and we really didn't have a chance to adjust. But we spiked out at a very high reading, well above 35, and now we're starting to come down. We're still really high at 30.5, and so I just say here, again, are we going to continue down? If we continue down with this, that means stock prices will need to fall, or earnings are going to have to go up massively, or a combination of the two. Since we're seeing a lot of economic problems right now, and companies are coming out, and a lot of them are revising things down, the E part of this equation, or the earnings, is not really kicking into gear. The price is what might have to give in. This doesn't necessarily mean it's going to happen right away. This is just something that we want to be aware of. And yes, the market is expensive still when looking at this. So we just put this in the back of our mind and just realize this is happening. And I'll update this as I do the videos each week. Another thing that came out from FactSet is there were the highest number of S&P 500 companies that cited inflation in their first quarter earnings calls, the highest that it's been in over 10 years. And I have it circled down here. So when they come out with their earnings and then there is a conference call and they just take a transcript of that and count how many times did they say inflation? Well, it was pretty astronomical here. We also had an update with Morgan Stanley. This is what they're forecasting earnings to be, and it's below what the rest of the market is considering, as well as into 2023. They're also below what the rest of the market is considering. This is another interesting chart. It's called the S&P 500 Cycle Composite. And what this does is this places an equal weight on the 1-year seasonal cycle. Some companies have a tendency to do better in the fall, some do better in the spring, some do better in the summer, and other stocks tend to perform better during different parts of the year. So they throw that into this calculation. They take the 4-year presidential cycle, and there's been all kinds of research done on that. They throw that into this calculation. And then there's a 10-year decennial cycle that they throw into that as well. They mix it all up, and they come up with this blue line. This is what they think is going to happen for 2022. It's not necessarily a forecast. This just gives us something to use as a guide. We've been following that. That's the yellow dotted line here fairly closely. as this has been going down. The S&P's been going down. Well, according to this chart, we bottomed in July and then spent the rest of the year going back up. They really anticipate things getting better as the year goes on. This is pure fantasy. We don't know if this is going to happen. This is just a model for us to look at and make some comparisons, again, to keep in the back of our mind. Let's look at the economy. As I've mentioned a couple of times, the CPI came out on Friday and it was up 8.6%, and that's a real spike. Other things are also going up, and I bet you knew this without even looking at this chart. Energy's just been going to the moon. Everything has been going up. Food, services. This is the CPI that came out, and it's on a non-seasonally adjusted basis. That just means it's the raw number, and this is what we got yesterday. So this gives you a historical look. These gray areas are recessions. We also have a seasonally adjusted, which they kind of go in and monkey around with things and try to make it more of a realistic number. That was calculated as 8.5. Looking at all of the different items, once we take out food and energy, of course, the things that you have to have, it was up 6%. And then here, this is a thing called a sticky price and a flexible price. There's a lot of controversy about how the CPI is calculated. They say it's not realistic. They don't use what real people use as part of their life to determine what's happening. What I say here on this chart is if price changes for a particular CPI component occur less than every 4.3 months, now how do you like that? Can't they do 4 or 5? No, they have to do 4.3. That component is a sticky price. That means it doesn't change very much. Those that do change more than every 4.3 months or sooner than that, they're considered flexible. So we kind of keep an eye on this. And this is just showing where the flexible ones, they're just flexing all the way up, where the sticky ones are going up, but not necessarily as much. This is the interesting thing. And if you go to a website called shadowstats.com, it's one thing to have them tell us that CPI was at 8.6%. Cool. But if we go back to how it was calculated in 1990, see this orange line here, this is what we were told. That's 8.6. But how it was calculated in 1990, we would be up at around 11 or so percent. They changed how the CPI was calculated. That's not the scary part. You remember those correlations to the late 70s, early 80s that I've been talking about? If we go back to how the CPI was calculated in 1980, we would be at about 17% and probably higher than that. We're pretty much double the inflation rate that we're being told if we go back to the same way it was calculated in 1980. I also took some screenshots of some headlines. Here's one from the Wall Street Journal. Just talks about how we hit 8.6% inflation in May. MarketWatch also says maybe now 50 basis points isn't going to be enough at this week's FOMC meeting. Maybe they're going to need to raise it 75 basis points. Just get ahead of it. So now the debate is going back and forth of what's going to happen. Bloomberg came out and said that there's a lot of trauma in the market right now as the S&P is just going down and down. The scenario that the market had been developing is maybe inflation was starting to come down. Maybe they will not have to raise interest rates as much, if at all, in the fall. Well, with Friday's report, that blew that all out. There's also a lack of confidence in the Fed right now, and that's one of the reasons why the sentiment survey that I went through, that's why it really went down. And then, of course, as everybody listening to this probably knows, we are at a $5 average for gas. Another thing that's really having an impact are diesel prices. And it's been a few days since this chart updated. It's probably like way up here now. And since so many trucks and machines and things use diesel to transport things, that'll eventually work its way, if it hasn't already, over into the prices that we have to pay. The GDPNow, they came out this week and revised their little model that they have and lowered it. Looking at the Fed, it's a 96.4% chance that at this week's meeting, we're going to be at 1.25 to 1.5 after the meeting. We are at 3/4 to 1. So they're going to raise it probably another 0.5% or 50 basis points. And you still have the little holdouts over here who think, no, we want more than that. Here's the historical chart. Sometimes if you really want to watch a lot of squiggly lines, this is a good chart to look at. Looking at the July meeting, and this actually declined quite a bit. It was up into the 90 range. Well, with the big CPI report that came out, this got lowered to 80, and there's more people jumping on the bandwagon that we might even raise rates more than that. There's going to be another CPI reading before this meeting, so we'll have to see how that goes. And there's even a small percent that want it even higher. And here's the corresponding chart for that. Then we're starting to look out into the September meeting. They're not as convicted about what's going to happen here, but I just want to start watching this now. Here's this funkadelic chart that you can look at if you really want to tease your eyes. I went over this in the daily video, but what I like to do in the weekly video is show you the Fed balance sheet. I found this graphic that put the S&P over top. And here's QE 1, 2, and 3. And a lot of people are under the impression, whether it's legitimate or not, that the rise that we saw in the markets after that was because of quantitative easing. There's also those that hold to the side that the quantitative easing that came in after COVID hit, that has really helped push prices a lot higher. Okay, if that is true, they're starting to sell the things that they purchased, and so this red maroon area is going to start to come down. It's already starting to come down. Is that going to have an impact on stock prices? One person that I really respect is Edward Yardeni, and he has a lot of books. He has a website. He does a morning briefing, and he has some very interesting charts. Instead of just showing you the Fed balance sheet, that's the blue line here, he came out with a chart this week that has the S&P over top of it as well, and it shows how we've been coming down as the balance sheet has been rolling over. The Fed funds target rate, according to Goldman Sachs, their forecast is by 2024, we will be at 3.1%. This is where we're at right now. We're starting to go higher. The futures markets are also pricing in a big increase beyond where we're at right now. Let's go in and look at breadth and start looking at some charts. We saw a negative week based on price and volume. Our advanced decline ratio is also negative and declining. New highs and new lows are still holding up. They were holding up on the daily chart and just switched over negative. They're still holding up on the weekly chart. So this gives us a little bit of hope, at least on a trending basis. Accumulation distribution is still negative. It's below the moving average. Looking at our trend, the ADX on the weekly chart is really advancing. So this shows a strong trend. The red line is on top and advancing. So that trend is negative, where we see the green line below and declining. The Arun was pretty much flat. As we continue to see a decrease in selling, we're also seeing a decrease in buying. And so our oscillator between the two is negative overall and didn't change in the past week. The mass index, we're still waiting to see if it will come down below this dotted red line. It did do that on the daily chart like a week and a half ago, but it hasn't really helped things. Long-term charts, no changes in the decision point scorecard. They're still positive on the short term based on their trend model, as well as their PMO. They're neutral with their trend model, where they switched to negative last week. Long-term, they still have things negative. Here's the daily chart just showing the different pivot levels, and this was kind of major. We came back down below S1. Looking down at the bottom, volume did increase a little bit over the previous week, but we're still well below average. We're well below the 50-period moving average. The long-term trend, and again, you're going to hear a lot of the same thing over and over. Recent death cross, downtrend. Bullish percent index. It had been hanging in there and giving us some positive signals, or at least some hope. It dropped back down. Chaikin oscillator also declined over the past week after coming off of an extreme negative reading. The force index also declined. McClellan oscillator, which had pegged up extreme positive, well, look at now. It's going down into extreme negative territory. My, how fast things can change. The summation index, it's negative because we're turning down, but on price, we're still above zero. We're declining based on volume and also just slightly above zero. All of our momentum oscillators are starting or either continuing to show weakness right now. The PMO is declining. That's one of the oscillators we just looked at. We saw a bit of a decline based on price, but we're still above the red line. And we saw a bit of a decline on volume, and we're also still above the red line. These are some of the more positive looking charts right now. The PMO study, after giving us an extreme positive reading, has now quickly gone down to extreme negative. The buy signals, these are all the stocks inside the S&P. They're not generating as many buy signals, so that is declining, and we're pretty much flat with those that are above zero. The RSI is not extreme negative, but we are declining and below 50. Special K, it's still above the moving average, so that's positive, but we're seeing real weakness here. The Swinland Trading Oscillator was giving us almost an extreme positive reading. Now we're back to extreme negative, both based on price and volume. Stochk RSI is negative. We're below the 0.5 and not necessarily extreme. Williams percent R, we are extreme, so that is negative. The Vortex indicator has the red line on top and it advanced slightly. The green line, which is buying, that decreased, so that's negative. Ultimate Oscillator also declined over the last week. Money Flow Index actually turned up a little bit. Sometimes this indicator is kind of hard to figure out. The Bollinger Bands are declining right now. We're below the dashed line. KST has been negative and continues to be that way. The percentage price oscillator also has been declining. The rate of change going back 1 week, we're not necessarily extreme negative, but we are negative. The rate of change going back 50 weeks shows that we're still below this dashed line and declining. The Copic curve, which gave us a nice signal on the daily chart, is still declining overall. We want to keep an eye on the Fibonacci levels. This is another weekly chart of the S&P where I drew some Fib levels going from the COVID low to the all-time high. Isn't it interesting how we came right down to 38.2 and bounced up off of that? We're in danger of coming down to that level again. If we really break below this, now we will be into bear market territory. Looking at some of our different charts, the Heiken Ashi is looking more negative since it has a dark candle. The Kegi is still red, so that is negative. The Renko drew another red box, that's negative. The equivolume, what I look at down below is a thing called the ease of movement, and going back 14 periods, it is declining. I also go back 1 period as well, so we're negative across the board with this indicator. The point and figure chart did not generate a new signal in the weekly chart, but we did draw in 3 new red circles, which is negative. 3-line break, painted in a black bar, so that is negative. Our different trading systems, the Elder system is negative. Parabolic SAR continues to be negative, and it just switched over to negative after Friday on the daily charts. Looking at some other things, here's just a eyeball look at the S&P on the top, the mid caps, and the small caps down below. Sometimes just by looking at this with nothing on there might give you interesting perspective. All stocks, which looks at not only U.S. stocks but world stocks, continue to be in an overall downtrend after having given us a recent death cross. Mid caps, death cross, down. Small caps, death cross, down. Dow, death cross, down. NASDAQ, death cross, down. NASDAQ 100, death cross, down. NYSE, death cross, down. Wilshire, death cross, down. I could just record this once and loop it. FANG stocks had another negative week, but not as bad as maybe you would have thought. They were down 3%, but still, death cross, down. ARK had a pretty difficult week here. Death cross, long time ago, and has spent 2022 pretty much fighting for its life. The 30 biggest software companies in the U.S., they continue to be in a solid downtrend. Here's a look at Dow theory just to compare with no study, no annotations on here. The Dow is up above, the transports, which also had a difficult week. Utilities, which had been doing much better, they were also down on the week. Looking at the CRB index, it was up for the week, 0.78%, and is in a very solid uptrend. Gold is still above its moving average on the 50. Silver is having a little bit more trouble. We're seeing kind of a golden death cross there. How's that? Oil spiked all the way up here, but we ended up closing at 120.67 for the week. There's other times when oil spiked, and I've gone through this in the daily chart. The thing that kind of concerns me is World War I. That was a pretty big deal. Yeah, we study that in history. I'm a history teacher, and I teach a lot about that. Different wars between Israel and the Arab nations in the Middle East, and there was an oil embargo. If you grew up in the 70s, we had the oil shock of 73 and 79, the dot-com bubble, the great financial meltdown. Well, what's so special about 2022? Could it be Russia-Ukraine? Could it be something that's happening in the economy? Could it be an event that hasn't happened yet? Other than just regular market forces, is this historic, what we're going through? Yeah, a lot of things are different, and there are things that are unprecedented that are happening. We can't really look back on an event yet. We can look back at COVID, but we're beyond that now. Here's another chart just showing also 1960. This is when OPEC was founded. 1973. That was when we had the gas lines originally. Then in 79 again. We are having trouble with Iran. The Gulf War in 1990. The credit crisis 2008. And now it's spiking up as we get into the Russia-Ukraine war. If that ends up escalating, that might be what the big event is. Natural gas really is spiking up. Everything related to energy is going higher. Even though it was down on the week, it's still pretty high. The dollar has been bouncing back up. It was up on the week. A lot of the losses that we saw a week ago, it was able to get those back. And this is what we've been watching for on the daily charts. When we spiked up back in May, a lot of times when something significant happened, we saw some real dollar weakness after that. Well, what's happening now other than just craziness? The dollar had been falling down close to this line here at 100. Well, now it's starting to go back up. Bitcoin just camped out. Last time I looked, it's into the 27s now. I haven't seen it that low in quite a while. You got a lot of really confused people. They thought Bitcoin was going to the moon. They still do think it's going to go there. We just might have to go through the sun first. And this is just showing how back in November, just a few months ago, the market cap for all the cryptos was at 2.9 trillion. As of right now, when I'm recording this, we're down to 1.1 trillion. That's still a lot, but look at how far it has fallen. Looking at some bonds and interest rates, this is where they're implying that the Fed funds rate will be at 2.9% by the end of 2022. We're not there yet. We're there with treasuries. The 2-year yield and everything else is up over 3 now. But the Fed funds rate is still very down here and looking to go higher. We're seeing a real spread between the two. Here's the bond ETF. This is put out by Vanguard, and it just shows bonds on a price basis have really been having trouble. The 10-year yield is threatening to break above what had been pretty solid resistance as we continue to go higher. Or are we going to turn and come back down? The 30-year yield is also starting to break out as well. And this was some pretty significant resistance that we're starting to go above. Now, we could still come back down. There's nothing necessarily magical about these lines. These just give us reference points along the way. And see how they're all bunching up here? It's like all the interest rate yields got together and said, let's have a party. We're going to make the 3-month stay a little far away, but all of us, in fact, we even have a couple of these that are inverted. The 30 to the 5 is inverted. The 10 to the 5 is inverted. So things are kind of crazy right now and really bunching up as far as the yields are concerned, especially this 2-year. And we've been watching that heavily on the daily charts because there are some things that might happen that could be positive for the market that now don't look so positive anymore. Internationally, this is a weekly chart just showing how the US, UK, and Germany, they're really spiking up. You notice that Japan is just creeping along sideways. I am going to address why, and I'm doing some research on that. There are some potential big problems in Japan that goes back decades. And that could eventually bleed over into the US because they own most of our bonds. after the US government, Japan is number 2, and then China comes after that. So if they have to start selling US bonds, that means prices go down, interest rates go up. That could have an influence on the US economy. So far, it hasn't really rumbled to a boiling point yet, but it could in the future. But this has been building up for a long time. Looking at some relative studies, bonds are really underperforming stocks, even though over the past week, we're seeing a little bit of a breakout here. Stocks did decline, but on a relative basis, looking at this monthly chart, we saw a bit of a decline this past week, but we did see a recent breakout going all the way back to 2000. Here's our intermarket analysis chart showing how oil's been doing the best. The dollar, believe it or not, is in second place. Gold is still slightly positive, where stocks and bonds have been negative going back to the beginning of the year. The gold to the US dollar ratio, gold was up okay. The US dollar is pretty strong, so we're seeing this decline slightly. Gold to the S&P, even though gold is not doing very much. I've been listening to some podcasts, people that I usually pay attention to, and these are folks that are supposed to be gold experts, and they're like, how come gold hasn't risen? And I honestly heard one guy say, I don't know. It should be going up, but it's just not. And I don't know why. The low volatility stocks have really been outperforming the SPY on a ratio basis. Growth has been really underperforming value. The NASDAQ 100 has been underperforming the rest of the S&P 500, as has the S&P 100. The biggest stocks in the S&P 500 are not doing as good as the other stocks in the S&P 500. Discretionary has really been underperforming staples. Energy, which is just going to the moon, has really been outperforming tech. So what's our outlook then for this next week? Things that we want to keep an eye on. On Tuesday, we have the PPI coming out. The CPI was on Friday. That's consumers. That's us. PPI is for producers. That's the people that make things. Then on Wednesday, that could be a pretty big day. We have retail sales. That's a big influential report. And then we have the FOMC meeting, which will be concluding. We'll see what they do with interest rates. There will be a statement. There'll probably be a press conference after that. And the markets could gyrate all over the place, especially as freaked out as everybody is right now. Then on Thursday, we get housing starts, building permits, and jobless claims. Then on Friday, we have industrial production and capacity utilization. The big day this week appears to be Wednesday. Any day could be big, but just looking at this ahead of time, that's when we really want to pay attention to things. Things to watch, the technicals were negative across the board. Everybody's freaked out about inflation and interest rates, which are producing growth concerns. We've got a whole list of geopolitical concerns like Russia, Ukraine, things going on in China, the supply chain. Also, we want to keep an eye on oil, Fed speak. We're going to get a lot of that this week. Earnings as they come out, and then the longer-term situation that I alluded to in Japan. So our different scenarios. Now, I base this on the daily chart. If we look at this on the weekly basis, this should be gold right here. We are in a downtrend, but I base this on the daily charts. Because of rising interest rates, inflation fears, this is what will keep things going down. Earnings, Fed speak, all the stuff I talked about, selling into strength, and the technicals just suck right now, both on the weekly charts as well as on most of the daily charts. Positive, what could help us go up from here? The technicals really are not good right now, but there might be disbelief in the markets that it's never going to go higher. It can't go up. It can't go up. And that's about the time when it does go up. We have a lot of these different positive scenarios, which are pretty much off the table, except for one. It's called the Staples spike. And if you're interested in that, please look at the daily videos that I do. I address all of these things in each video. The other signals that we were looking at that sometimes mark a low in the S&P, they're pretty much off the table right now. And the technicals are not very favorable. So we're looking at different pivot points that happen on the daily charts as well as the weekly and monthly charts. We're trying to get back to the short-term moving averages. We're looking at Fibonacci retracements and then other levels that we hit, like the previous low. If we end up going lower, is that going to provide support? Then on the daily basis, we are in a neutral trend because our ADX on those charts is below 20, but the red line's way on top. So thank you. I hope you have a wonderful week. If you have any feedback on these videos, things that I should include that I haven't, and vice versa, please let me know. And yes, I'm talking a little extra now because I don't want to have the end cards that YouTube wants me to put on my videos to overlap some of the things that I was saying. So I'm just sitting here talking and trying to add another 30 seconds to the video overall. Way to come back, Seattle Mariners, in the bottom of the ninth inning. Yes, yes, yes.